Hi everyone, Rich Saperstein, Chief Investment Officer at Treasury Partners. What I'd like to do today is put everything together: stocks, bonds, earnings, and where we see investors placing capital right now. First of all, we are optimistic on equity prices this year as a result of the fundamentals, the Fed being accommodative, and the overall geopolitical environment. While volatile, we expect it will be net positive for equities. And here you can see the long-term chart of the S&P and earnings. Earnings on the blue line, the red line, and the S&P on the blue line. And within certain bands, stock prices follow earnings. And we expect earnings to increase year over year on the S&P, which will enable the stock prices to move higher. But it won't be without volatility. This chart shows the volatility going back 45 years. And you can see the returns on the market and the drawdowns that have occurred in the market. So to summarize, the average drawdown in a year in the stock market is 14%. But on average, 2/3 of the year, the stock market is positive. Now, we spoke about previously the volatility coming out of the White House. So we expect to see some volatile periods, yet we do expect to see a positive year ahead. But this chart really reinforces what an equity investor should be thinking about in holding common stocks. If we bought stocks in a 60-40 portfolio in 2019 and didn't do any asset allocations, today it would be an 80-20 portfolio, meaning 60% in stocks, 40% in bonds. In 2019, no changes. That would be 80-20 as a result of the growth of the stock market over the 6 years. So within client portfolios, we're constantly looking for overweighting in any one sector or in any asset class and looking to make readjustments. And finally, what I want to just review is optimization of portfolios. And here is a chart that shows asset allocations going back 50 years and the best, worst, and average returns of these dual combination asset class portfolios. And you can see that typically in a 50-50 portfolio, the downside is roughly 15% in a year with an average of a 10% return. If you move towards 60% equity, you pick up about 5% more volatility for very little incremental return. So this chart is indicative of volatility, historical returns, and the best combinations of dual asset class portfolios. So to sum everything up, I think that it'll be a positive year for equities, heightened volatility. It'll lead to opportunities. Very important to have bonds in the portfolio, enable to have a stable asset that you can capture to reinvest to take advantage of price discrepancies.